My name is Broughman, and I am a professor of law here at Vanderbilt. So one aspect that my research does address, a question here, is whether the extreme levels of risk that some startup companies pursue is driven by simply bad apple founders or is driven by incentives. And I think the investors, rather than being the victim of fraud, as in the case of FTX, are themselves actually encouraging and enabling this behavior. And they're encouraging it not simply by not taking seats on the board or something like that, but by providing financing and an incentive structure, basically payouts to the founders that go up extremely high when the company does very well. Society needs to get a better sense of whether this is actually bad for us. Like, America actually benefits in many ways from having these big tech companies here. So I don't want to go the route of saying we need to just regulate and shut them down. This seems to be the current route of where our antitrust law is going. But I do think it's at least worth paying attention to this when we start to design securities regulation that looks at private companies. I think my study gives a lens on how they should look at regulating. It's not just about disclosure. That would be the real key hook here. It's about trying to force the VC investors to pay attention to potential harms they have for the rest of society. I teach mergers and acquisitions. I teach Intro to Corporate Finance, which is a course for lawyers that want to have a little bit of background in finance. I also teach the Corporations or Business Associations course. And I teach a seminar on venture capital, which is really close to my research. That and the corporate finance course are close to my research.